Okay, so good evening, class. You're welcome to another class on financial reporting. My name remains Wasiu Okwola. So today, I'll be starting a new topic, and this topic is on IAS 38 on intangible assets. And what do we have in front of us to cover on this standard? So on this standard, we will be looking at basically the accounting treatment for intangible assets. We would also look at the criteria for recognition of intangible assets. We would also look at how to measure the carrying amount of intangible assets. And finally, we'll look at the disclosure requirements for intangible assets. So the first thing we need to look at is the definition of an intangible asset. That's what is an intangible asset itself. According to IAS 38, it says that an intangible asset is an identifiable non-monetary asset without physical substance. An identifiable non-monetary asset without physical substance. So this is a definition you have to know. So let's break it down and see if it's going to make sense. So there are three elements in this definition, which we're going to look at in the next 10 minutes. The first one is identifiable. The second one is non-monetary assets. And the third is without physical substance. So let's see it. The first one, which is identifiable. So what do we mean by identifiable? So for an intangible asset to be identifiable, it means two things. Number one, either it is separable or it arises from legal or contractual rights. So when we say identifiable, it is either that item or asset, in this case, it's separable, or that item is arising from legal or contractual rights. So any of them, any of the two, can make the asset identifiable. Let's pick them one by one. The first one, a separable intangible asset. When we say separable, it means that that item can be separated from the entity as a whole, which means that it can be acquired from the entity without having to acquire the entire company. So it means it's separable. You can actually sell it separately, or you can rent it out, or lease it out, or transfer it to another party. So it can be separated from the entity. It makes it to be separate. And examples of intangible assets that have this separability, okay, that are identifiable because they are separable. Example of them are licenses. There are certain business you would want to do in Nigeria today. You will need a license. Typically, let's say banks. Before you can operate a bank in Nigeria, you have to be licensed. You see, this license is an asset to the bank. It's an intangible asset, right? And one of the reasons why it is intangible is the fact that It's identifiable. And that's because it's separable. And when we say separable here, it means that you can easily sell that license to another person. It can be sold, like you can sell it separately without having to sell other assets of the company. You can sell it separately. Or a patent, when you have an invention, when you have a technology, when you have a creativity that you don't want any other person to just come and copy, you patent it. So people would always direct the origination to you. When you have that patent, you can decide to sell it. It's something that you can sell. So you see, either license or patents, they are intangible. They are not something you would see with your eyes, but you can actually sell them. So they are actually separable. Another example of intangible assets that are separable, or that is separable, is a brand name. A brand name. For example, now, let me say, um, GT Bank, just for example. So if they have a brand name, they can decide that, okay, use our name. They can say, use our name. So go and open a branch somewhere, then you will pay certain amount of money. But that brand itself, okay, they can allow any other person to use that name if they wish. Of course, there will be an agreement. So that brand is an intangible asset because it's separable. They can actually sell it or transfer it or rent it to another person. Thank you very much. Even equity professionals also is a brand name. So we can continue with so many examples. But the point here is this. When we say separable, it's one of the items that can make an asset identifiable. You can sell it separately without it affecting the entire entity. Apart from separable, identifiability can also be as a result of legal or contractual rights. Okay, as a result of a contract, the existence of a contract. A simple example that I want to start with is a franchise. A franchise. Most of the KFCs today that you see, all these outlets you will see around, it's actually a franchise from the main KFC. So it's similar to brand name, right? So, but the guy that is holding it, the person, like if I want to open a KFC outlet now, I could contact KFC and say I want to use their name. Okay, then we'll sign an agreement. Then they will say, okay, go ahead and use our name. So for me, it is not my brand name. For me, I have a franchise. It is an intangible asset to me because it is arising from legal or contractual rights. I have signed a contract with KFC. Or if I want to open a filling station now, I could go and meet NNPC and say, I want to use your name. Can I use it? Okay, we'll sign an agreement. So in my books, the fact that we have signed an agreement and I can use that name, that's a franchise to me. It's a franchise and it is an intangible asset because it is arising from a contract. So you will see that for me, the guy that wants to use the name is a franchise. But the person that has actually worked over time to build the name to him is a brand name. I mean, that is like a mirror image of the the two of them. So another one is this you would find majorly in a consolidated account where companies or either a subsidiary or a parent, let's say a subsidiary, they have a lot of contracts with major customers. So if let's say I'm the parent, I now acquire that kind of company that has deals, many deals with a lot of customer that they have not executed. For me, that's an asset. I want to acquire a company, and this company they have already entered into contract with key customer. They have a lot of government contracts that they have not done, and I want to acquire them. Is an asset. So though this is just a contract, so it's an intangible asset that is arising from contractual rights. Okay, so that is one of the item in this definition of an intangible asset, identifiable. An intangible asset must be identifiable. And when we say identifiable, it means it is either that item it's separable. That is, you can sell it to another person. You can rent it to another person without having to sell the entire entity. Then it becomes separable. An example of those I told you, we have license, patents, brand names, and many more. Even your copyrights and a lot more like that. And also, identifiability can also arise from legal or contractual rights. I gave you an example of if you buy a franchise, it is an intangible asset to you, the buyer, but it is arising from legal or contractual rights. Or you acquire a subsidiary that has a lot of customer contracts. It is an intangible asset arising from contractual rights. Okay, so identifiability can either arise from being separable or arising from legal or contractual rights. Okay, the second part of this definition is non-monetary assets. You see, for you to understand non-monetary, I think you need to understand monetary. You see, assets like bank accounts, or which we typically call bank or cash, right? Or investments, right? You see, the benefit you get from your investments or your bank, both of them are assets. But this type of assets, you know how much you will get back. Your bank, you know how much is there. So if you need your money, you can go there at any point in time and withdraw a fixed amount. Your investments, either in shares or debt, you know how much is there at a particular day. It might fluctuate, but you know how much is there at each day. You can go there and liquidate it and get a fixed sum. Even trade receivables, right? Or even loan receivable. You see, any item of assets where you receive a fixed sum on liquidation, where you would receive a fixed sum on liquidation is a monetary asset. And that can never be an intangible asset. Even though, really, when you look at bank or cash, it's not something you see. I mean, it's not something you can go and see anywhere, or investments. They are intangible in the real sense of it, or probably trade receivables. They are intangible, but they do not qualify under IAS 38 because these items are monetary. They are monetary. So non-monetary, from what I've explained, goes to show that the benefit you would get varies. It varies. It's not fixed. It depends on how well you use it. Your license, for example, now. You cannot say, since I have a license now, I'm sure I will be getting 20 million every month. No, it varies. It depends on what you do with it, how you structure the business, and how creative you are. So these are non-monetary assets. So intangible assets are non-monetary assets in the sense that what you would get from them varies. The benefit you will get from using them varies. And the final component of the definition is without physical substance. I mean, to keep this simple, without physical substance means you cannot touch or see them. In fact, in today's world, when we talk about intangible assets, they are often technological based. They are often technological based. Now those are the typical, aside the one I've mentioned earlier, like licenses, like patents, like franchise, like brand names, like copyright. You see, most intangible assets can be attributed to technology, like your website, like your app, like maybe a database or even a web server. I mean, of course, there are key infrastructure for server that are physical, but a lot of companies they mostly use like a cloud server. So all of these are assets, but they don't have physical substance. Yes, or softwares, majorly softwares, yeah. Okay, so that is the definition of an intangible asset. You see, at every time I'm teaching this, right, this particular topic, I know I have to explain each of these three items. But I don't know, I always wonder, why did they come up with this kind of definition? Because if you look at it very closely, if you look at it very closely, this definition it's almost similar to what we did last week, PP. PP. This definition can go for it, except the fact that it's just this without physical substance alone. But PP is also identifiable because when you have your, let's say, a motor vehicle, you can sell it. They are separable, right? They're actually separable. And you have some physical assets that arise from contracts, like leased asset, right? So non-monetary, most PPE are non-monetary. You don't know how much you would make from them. It depends on how well you use the machine or the plants or the motor vehicle. It depends on how judicious you utilize them. So, I mean, but it's okay. You have to learn it and understand that this is how they want to go. So they choose to define intangible asset this way. And I mean, with this now, we understand what identifiable means. If you see it anywhere else, it means the same thing as far as reporting is concerned. Separable or arising from contract or legal rights. Non-monetary, what you are getting from it is it's not fixed, it varies. And of course, without physical substance. Okay, so I can see Olakule mentioned intellectual property. Yes, it is an intangible asset as well. It meets this definition. Now, it is not all intangible assets that will get recognized in the books. But before we go to recognition, let's look at this scenario first. It says in 2003, Entertain Co. entered into negotiations to acquire the Gadget Works brand from Gadget Co. for 1.2 million. This will give Entertain Co. the ability to sell products under the Gadget Works brand and give access to the Gadget Web domain name. Entertain Co. did not wish to acquire any other asset of the Gadget Co. business, such as other brands or properties. So therefore, had no interest in acquiring the Gadget Co. business as a whole. Okay. Okay. So you will see that in this example, this guy this guy called Mr. Gadget Co. He has a brand that that Entertain Co. is interested in. So, and all he's interested in is just to use this guy's domain name, that name, so that everybody would also do business with Entertain Co. So, and it's clear here that Entertain Co. does not wish to acquire any other assets of Gadget Co. So he's only interested in just that domain name. So that goes to show that that brand name is an intangible asset. And of course, it has no physical substance, but it is an asset. Okay, now, when you have an intangible asset and you have identified that this is an intangible asset, when can you recognize it in your books? When can you recognize it in your books? There are two recognition criteria. And those two recognition criteria is exactly the same as that of PPE. So I won't repeat all those long teachings I did for PPE. I'm not going to repeat it here. It's the same thing. And number one is probable that future economic benefits will flow to the entity and cost of the asset can be measured reliably. Before you can recognize an intangible asset in the books, there must be future economic benefits, probable that future economic benefits will flow, and it must have a cost that can be measured reliably. That's recognition. The second one is, after recognition, let's go to measurement. Measurement of intangible assets. Now, the way you measure an intangible asset will usually depend on how you have acquired it or how you got it. So there are three ways here that I categorized it into. Number one is the one you actually purchased, like your license, like your patent that you paid money for, or your franchise. Those ones that you paid money for. So you measure those ones initially at cost. And if they ask you component of cost, it's the same thing as in IAS 16. I mean, you just have to put it in perspective for intangible assets. So we're not going to repeat all of that here. But there is something called intangible asset that you actually pay for. Those ones, you measure them at the amount you paid and any other attributable costs. But mostly, you'll find out that a lot of intangible assets would be internally generated. And a typical example would be your brand name or your goodwill. Those ones are, or maybe your intellectual property, right? Or maybe the skills of your staff. These are internally generated assets. They make money for you as a company. But you see, internally generated assets they cannot be capitalized. They cannot be capitalized. We don't recognize them in the books. That is why you will not see any company recognizing the skills of their staff, their intellectual property, their brand name, their goodwill. You will not find them recognizing it in their books. And why is that? Because number one, you cannot put monetary value to the benefits you will get from them. You cannot say this is how much I will get from having this name. You cannot. Or you cannot even know how much you have incurred to develop those good name. The major challenge is how much benefit can you get from them? How much did you even spend to get this good name? We cannot reliably measure those two ends. That's the major reason why why internally generated assets are not recognized in the books. Okay, so Temitope said you have seen goodwill recognized in the books. Okay, maybe we should hear from you, but if you don't want to talk, um, maybe I would clarify that later. So, if you have seen goodwill recognized in the books, so now we are training you to be an accountant. You should correct that. Is an error, right? Whatever I'm saying here now, it's not like I'm the one that's created it. No, I'm not the one that created it. All I've done is just to study the standards, right? So this is accounting standard. What guides us as accountants? So if you see any company, an individual company recognizing goodwill in their books, that is wrong. You do recognize it. So I've also seen it. So I am an auditor. So when I see such, I write it off immediately. So the explanation is always that that somebody paid certain amount of money to them to buy maybe some shares or what. They will shall give that explanation in that line. Somebody paid them for that name. I say that one is different. If person pays for shares, you give them shares. So you see, the only place where you can find goodwill is in the group account. Is in group accounts. And the reason for that is clear, is that we can easily get a value for it. Mr. Kazim will teach you how to get the value for goodwill when a parent acquires a subsidiary. So we can easily attribute the fact that the parent has paid a lot much more than the identifiable assets and liability of that acquiree or of that subsidiary. So that excess amount paid, we can attribute it to goodwill, right? So that's why you find it recognized in a consolidated account. But what I'm talking about here is in an individual entity account. The good name you have or brand name you have developed for yourself, that is not recognized in the books, right? Because of the difficulty in establishing the benefits or the amount allocated or that you use in creating such internally generated intangible assets. In fact, some people usually argue that we should capitalize training costs. That when you train your staff, it's an asset, it's an intangible asset that you should capitalize it. We would usually explain to them that no, you cannot capitalize training costs because these staff can leave anytime. They can leave anytime. So somebody that can leave, you cannot, that means you are not sure that you will generate future economic benefit from it. You can't control a human being. So just expense it. immediately, right? So that's internally generated intangible asset. Now, aside to that, there is another set of internally or another set of intangible asset generally that can originate as a result of research and development. Research and development. So this one will arise when a company incurred costs to develop a new product. So typically, let's say a company wants to develop an app now. So they would develop a cost. They would incur cost until that app is ready. So those kind of costs that you can directly trace to an output or a product or an item generally, we call those kind of costs research and development costs. And usually, the general practice is that these research and development costs, they can only be capitalized, meaning you will treat it as an intangible asset if they meet 6 criteria. So these 6 criteria, I shortened it as pirate because I can ask it a lot. So we're shortening it as pirate. So the pirate, the P is must be probable that to generate economic benefit. Number 2 is the I is intention to complete the project. The entity must have intention to complete the project. The R is resources is available to complete the project. The A is ability to use or sell the item. Ability to use or sell. Not something we just produce and it just be there as a decoration. You must actually use it or sell. And is it even technologically feasible? Not something you start and you cannot finish. It must be technologically feasible. And finally, is expenses on the project can be identified. So ICANN would usually ask you to list or state the criteria for capitalization of a development cost. So this pirate criteria will work for you in the exam. So usually it's common practice. You find that people would usually call any cost that does not meet this criteria, they will say it's research cost. But the reality is that it's research and development. So it's either you expense research and development or you capitalize. So there is nothing like, okay, all research costs expense, all development costs capitalized. So there are some development costs that can even be expense. So I see it as research and development costs. If it meets these 6 criteria, then you capitalize them, research and development. If it doesn't meet the criteria, you expense. Okay? But again, generally, you can separate it if you want, but I don't really want that because by the time somebody now brings up a research cost and says it meets the criteria, then that means there's a possibility that research costs can also be capitalized. So research and development costs, if it meets the 6 criteria, you capitalize them. If it doesn't, then you go ahead and expense them. So usually, the way you find ICANN or the examiner giving you the exam is they will give you a scenario about these research and development costs, and they will tell you that at this level, we have gotten regulatory approval, and we are sure that we'll finish it in the next 2 years. And we have some off-takers, stuff like that. By the time they are mentioning that, then you know that, okay, it will have met these criteria, because all of these criteria must be met. So a question will now not start giving you one by one. No, they will just give you a general scenario. Okay. We would look at a question to address that very soon. So, but the final one around measurement of intangible assets is in the consolidated financial statement. I've already mentioned this while I was explaining internally generated. So you'll find out that there is a little inconsistency brought in by IFRS 3 or IFRS 10 when you are doing consolidated account. So most of these internally generated assets or research and development costs that we do not capitalize, that we said don't capitalize, you find out that when you are preparing a group account or consolidated account, they will be recognized and measured in the statement, in the consolidated statement of financial position, right? And I've explained one of it to you for goodwill now. And most of these that now, because a parent is acquiring and paying for this item, so we can easily get a value for them, whether brand name, whether goodwill. We can say, okay, this is the amount it is because somebody has paid for the asset. So any amount above the assets, we can describe that as goodwill. And in some cases, they will specifically describe it as a brand name. So you would see them as you move on. So don't quote me that, we said goodwill is internally generated. We said brand name is internally generated. Why are they now recognized? Yes, in the consolidated financial statement, they are recognized because somebody has actually paid for them. So we can know their value. But in the individual account, they are not capitalized. They are not recognized in the books at all. Okay, so let's solve this question regarding research and development. So there's this company called Resco. It's developing a new line of pharmaceuticals, and it has spent 2 million up to 1st of January 2005. It has spent 2 million up to 1st of January. And I said on 1st January 2005, the board gave approval to fully fund the rest of the project following promising results, and spent a further 1 million to April 2005. So on April 2005, problems were discovered on the trials, and approvals was not given from the medical regulator for use of the pharmaceuticals. The Resco spent further 1 million to 1st July 2005, at which point approval was given. From 1st July 2005 to October 2005, Resco spent 1.5 million putting the product into final finished stage of development. The new pharmaceuticals are expected to generate revenue in excess of 20 million and have a useful life of 5 years. Okay, so this is just a scenario. Now, this is the solution I have here, right? So this guy, Resco, now, from this case study that I gave you, only 1.5 million will be capitalized because it is from July that all the development criteria were met. You will see that it's not like the examiner was giving you this pirate criteria one by one, but they painted a scenario for us. You see, this guy has been spending so much money. He has spent 2 million till January.
In fact, in January, he had board approval. Board was in support, and he has even spent additional 1 million till April. Even in April, he now discovered a problem, and regulator did not approve it, right? So he spent another 1 million up to July. So it was July that he got regulatory approval. So it is any cost he incurred from July going forward that we can capitalize. You see, these 2 million, this 1 million, and this additional 1 million that he spent trying to get all sorts of approvals, those ones will be expensed. You see, so it's only 1.5 million that will be capitalized, because that's when we can say that, okay, we are sure that this thing will generate benefits. We are sure that we can finish it. We are sure that it's technologically feasible. And we are sure that all of those pirate criteria, right? So all of the costs incurred while he was trying to get all the approvals, those ones will be expensive. So you will see that it's not as, that's how they want us to do it, but it's very controversial. That means that the major part of the costs, because by the time I accumulate 2 million, 1 million, that's 4 million. We are saying we should expense all of that. You want to expense all of that, and you're only capitalizing 1.5 million. So because of this present regulation, that's how it is right now. That's what we have to follow. But there are discussions going on that a lot of items would, and it would be so much pressure on a company that is just starting up. And you want them to expense so much money in their first year, because you believe that at that point, they have not gotten to a point where we can say that, okay, this project will be successful. Because that's what these guys say. They want the project to get to a point that we will say that, okay, there is no undo again. We have board approval, we have regulatory approval, then we're sure everything, success is very close to our eyes. We are very sure that we'll complete this project. Then any cost you incur going forward then should be capitalized. In the exam, very simple, very straightforward. You can easily tell. But in real life, it's very, very bad for especially startups, for them to incur so much money and they expect that they will expense it. So we find out that a lot of companies don't follow this. You find them that when they are developing products like this, maybe they are developing an app, you just be capitalizing everything. They capitalize. No one follows these processes, which is wrong. A good auditor that actually comes in should expense them. Why you should capitalize up to the point where they have gotten all necessary licenses, approvals, and whatnot. Okay, so that is initial measurement of an intangible asset. So it's either you are buying it and measuring it at cost, or you are developing it yourself internally in such a way that you would not recognize it in your books at all, or you are working on a product that you are spending money on. Then if it meets these 6 criteria, then capitalize it. If it doesn't, expense it. And we looked at a scenario of how that works. And finally, is subsequent measurements. We have already mentioned this in IAS 16, and it's the same thing here. The same thing. So we have cost model, we have evaluation model. For the cost model, the only thing that is changing here is depreciation is now replaced with amortization. That's the only thing that has changed. For cost model, is cost minus accumulated amortization minus accumulated impairment losses. That's that. So, however, the only peculiarity you find most intangible assets having is that most of them would have an indefinite useful life. Like, let's say a website, for example, now, it can have an indefinite useful life. Like some softwares or an app that you have, they will have an indefinite useful life. So when you don't know the useful life, remember, that's why we do not depreciate land. If you have an intangible asset like that, it will not be amortized. What IAS 38 requires us to do is to perform an annual impairment review. You'd perform an annual impairment review to check whether the asset is impaired or not. So I will teach you impairment laws very soon, maybe in the next 2 or 3 classes. We'll look at impairments, but that is what is required when an intangible asset has an indefinite useful life. Don't amortize it, but just test it for annual impairment. Now, the second one is revaluation model. Revaluation model here is the same thing as IAS 16. It's fair value minus subsequent accumulated amortization minus accumulated impairment loss. It's the same. So the peculiarity here, before you can use the evaluation model for an intangible asset, you see, that asset must there must be an active market in place. And when we say active market, it means that a place where transactions are taking place with sufficient regularity and volume that we can easily get pricing information on an ongoing basis. So for an intangible asset, before you can use the valuation model, which requires that you must get the market price of that asset, you must get a market. There must be an active market. There must be a place that, okay, that's where they trade these assets, and you can easily get pricing information. So you find out that most intangible assets, we don't use evaluation model because most of them, there is no active market. Or is there an active market for websites? Websites are distinct to every entity and depends on the complexity of your web app, and that will determine how you would determine your cost. So most entities, most intangible assets will use a cost model, majorly because of the requirement that there must be an active market where there is high volume of transactions happening on that asset, which doesn't exist for most intangible assets. So we find out that we will use cost model for most of it. Okay, so disclosures requirements. So the disclosure requirements here also similar for that of IEX 16. So you need to disclose whether the useful life of the asset is finite or indefinite. You need to tell us the amortization methods. In fact, all the disclosure requirements, most of the disclosure requirement for IS 16 is the same thing. So these are just additional that are peculiar to IS 38. So talking about research and development, if there is, then you need to tell us what portion of that research and development was written off and what portion was capitalized. If there is any of the useful life of the intangible asset that is finite or infinite, you need to let us know. You need to disclose that to us. But the same disclosure requirement for IS 16. So in the exam, right, you would find I can mostly when they want to ask questions on intangible assets is majorly research and development. Majorly. That's why you find them, they'll be testing this pirate, because that's the only special thing here. Every other one is the same thing as that of is very similar to IAS 16. And another one is these internally generated intangible assets. And you need to know and remember that we do not capitalize them because we cannot place value on the benefits they will generate or know the costs we use in developing them. Abi, can even we at equity professionals, we cannot say this is how much we have incurred for us to have our good name. We cannot, it's just the quality of the lecturers and mostly the reception you would get when you place a call through to us for the first time and our consistency. So we cannot say this is how much we have spent. It's majorly intangible efforts, good service that's created that. So internally generated, they are not recognized. And the fact that most intangible assets will have an indefinite useful life. So you need to remember that when they have an indefinite useful life, we do not amortize them, but what we do is to subject them to annual impairment review. And that is it for intangible assets. So let's solve some questions to round it up for today. Before then, if you have any question, this is the time you should ask before we go into solving questions.
Hello, sir.
Hi, Temitope.
Good evening, sir.
Good evening.
Okay. Yeah, so when you were explaining, I got to understand that for tangible assets, the PPE now, I noticed that when you calculate the costs of the assets, then you factor in the cost you incur before the asset is brought into use. But in this case, all those costs before the approval of that intangible asset are not calculated at all. It's because you incur after the approval of that asset that you factor into that you capitalize. Am I right?
Exactly. So you are right to a very large extent, but the context I want you to put to this is not relating it to an asset, but rather relating it to the fact that we are working to develop an asset. That asset is not there yet, or we are working to develop a product. So it's a development cost. So the cost you now capitalize are those where you are now sure that you would actually finish that development. You are sure that you would develop the product, which is when you have gotten all approvals that you need, right? On that development process. That's the context I would like you to put at it. Not like an asset is ready and you're not getting approval and the asset is not ready. We have not developed the asset. We are still in the process of developing it. But we need to be sure that you would actually finish and complete development. So they will attribute it to when all the approvals have been gotten and there is no due any further except just incurring money and time.
Okay. Thank you, sir.
You're welcome. Any further questions? I saw somebody, you raised up your hand now. You don't want to ask questions again. Okay. If there are no further questions, I need somebody to read this question for us. It's 5.1.
Intangible assets by their nature do not exist physically under IAS 38 intangible assets. The following information on initial cost of intangible assets were extracted from the notes to the financial statements of Igbo Wood Limited, a film production company on January 1st, 2017. Books and literary works, 800. QuickBooks and Sage, 950. Patents, 1.2. Video and motion picture films, 2.5. Franchise, 3,002. Pictures and photographs, 3,004. Order or production backlog, 4,000. Plays, 4,002. Customers contracts, 4,004. Trademarks for customers, 4,006. Broadcasting rights, 5,000. Internet, 5,004. Trade secrets, 48. Additional information. QuickBooks and Sage, date of acquisition, January 1st, 2016. Assessed useful life, 5. Trademarks, date of acquisition, January 1st, 2015. Assessed useful life, 8. Plays, date of acquisition, January 1st, 2014. Assessed useful life, 7. Franchise, date of acquisition, January 1st, 2013. Assessed useful life, 8. Intangible assets are to be amortized on a straight line basis. Required. Calculate the cost of the following intangible assets. 1. Market-based. 2. Customer-related. 3. Artistic-related. 4. Contract-based. 5. Technology-based. B. Calculate the carrying amount of the following intangible assets as at December 31st, 2017. 1. QuickBooks and Sage. 2. Trademarks. 3. Plays. 4. Franchise. Then C. Identify 4 internally generated intangible assets that are prohibited in IAS 38 intangible assets.
So thank you very much. The first requirement of this question required us to calculate the cost of the following intangible assets: market-based, yes, customer-related, artistic-related, contract-based, technological-based. Okay, so this question requires that you categorize the intangible asset into these categories. So let's see if we can categorize it, but this will be a very subjective answer, because when I can ask this, we actually complained because there's no way people will get the same answer. But let's see if we can get the same answer. So they gave us a list of these items. I think this entity is a film production company, right? So let's see. Let's try and categorize them. The first one, which is book and literary works, 800. Where can we put it? Market, customer, artistic, contract, or technology? Where should it be? Where do you think it should be?
Customer related.
Books and literary works. That one is clear that it should be artistic. It should be artistic related. Then there is QuickBooks and Sage. Where should that one be? Like QuickBooks and Sage.
Technologically based.
Yes. How about patents? Contract.
Patents should be contract based.
No.
Market-based.
Market-based. Why market-based?
I don't know, but I think patents relate to like I don't know, it's an intangible asset that relates to like the, should I say, intellectual property of a particular company.
In contract based, sir.
So it's actually subjective. So I can't say somebody is right and somebody is wrong. So I can put it in contracts. But the why I don't want to put contract, because usually when you have patents, they are usually not arising from contractual or legal. It's something you actually pay for, no problem, but and it's separable. So it's different from things like franchise that before you can have it, you must have entered into a contract. So patent is not coming from contract like that. It's because you have developed something. So they then give you a right that, okay, you are the only one that can say boldly that you are the originator of this. So I'm skeptical about contracts, but another person can argue why it should be contract, but it's far from it anyways. So let's leave it at markets. Then what about video and motion picture films?
Artistic.
That's
Artistic, yeah. What about franchise?
market.
Contract.
How about franchise?
Contract based.
Okay, yes. Contract. How about pictures and photographs?
Artistic.
Artistic.
Statistic.
Okay. What about order or production backlog?
Customers related.
Yes, we can take that. What about place?
Artistic.
Statistic.
Yes. What about customers contract?
Contract based.
Customer related.
Contracts or customer.
Yeah. So which one should we go for?
Customer related.
Okay.
Take a vote.
Yeah. It's very. So how about trademark? Trademark.
Trademark.
For customers.
It contract based.
Market based.
Okay. I don't
Okay.
even know.
Mm.
So
If I agree,
what about broadcasting rights?
broadcasting
Like,
right,
Casting
that's
rights will go under contract.
contract.
is it contract?
The market.
Can use that as market.
Okay. What about internet?
Technology based.
Technology.
How about trade secrets?
Market.
Secret.
Confusing.
Market based.
Even I will put this trade secret in technology, say for them. And this internet, most people will put it in technology, but it can also be market as well. So you will not find a question like this in the exam. So that
I hope
diet,
so.
yeah, no, you will not. So that diet, we actually complain about this, and almost all students have attempted it. If you attempt this one and you just put any of them anywhere, be sure that you will get all the marks. Because even those that provided the solution self, they could not agree on where they should put it. They were not getting the same answer. So they just give everybody, since it's highly subjective. So it's a student that will say, I don't know, and they leave it and not do anything. Those ones will get zero. But if you just attempt and just even if you put place under market, you will get your mark. Just do something. So that's that. So this is how I've arranged it here. Anyway, I put only trademark in markets. I put orders or production backlog and customers contracts in customers. I put all these other ones in artistic. Then I put franchise and broadcasting rights in contract based. Then in technology, I put QuickBooks, patent, trade secrets, and internet. So it's arguable. So, but I just put it majorly to solve this B, where they ask us to calculate the carrying amount. Carrying amount at 31st December 2017 for QuickBooks, trademarks, place, franchise. So that's where we're actually going. So for QuickBooks, and don't forget, the way we determine carrying amount is cost minus accumulated amortization for this case. So for QuickBooks, you will see that the cost of QuickBooks is 950. The useful life of QuickBooks is 5 years, and they acquired it on 1st January 2016. So the challenge, which is not really a challenge, is just calculating the accumulated amortization. It will be the cost all upon the useful life. That will give us the cost per annum multiplied by the years to date. Since they want us to calculate this carrying amount at the end of 2017. And we bought these QuickBooks in 2016. That's 2 years ago, 16, 17. That's 2 years ago. So, and that's why we are multiplying this by 2 years. If you press your calculator, it will give you 20. Sorry. And by the time you remove that from the cost, it gives 570. And the same thing applies to the other one. For trademarks too, the cost is 46. If you check the useful life for trademark, is 8 years. So it will be 4 over 8 years. We bought it in 2015, and that will be 3 years ago. And that will be 3 years ago. So, and that is why they multiplied by 3 years. So 46 divided by 8 multiplied by 3 gives us the accumulated depreciation, and we get our carrying amount. The same thing for place. The cost is given, it's just the accumulated depreciation. That means this is useful life, and we bought it 4 years ago. The same thing for franchise. 8 years is the useful life, and we bought it 5 years ago. All right? So we get our carrying amount. And that's that. And finally, they say we should identify 4 internally generated intangible assets that are prohibited in IAS 38. I think we have mentioned that in this class. What are the examples I gave you?
Goodwill,
Yes, that's one. We need 4.
brand name,
That's 2,
Staff
correct?
training. Staff training.
Staff training, that's correct. Well, staff training, you will be wrong, because staff training is actually recognized in the account, but as an expense, not as an asset. So we are talking about those that are not even recognized in the account at all. So we have goodwill.
But it's an expense, not intangible asset in this case now.
Yes,
So
no.
it is prohibited.
It's prohibited in IAS 16. So we are saying items that are they are actually intangible assets. They are an intangible asset, but we are saying don't capitalize them, don't recognize them in the books at all. So staff training is not an intangible asset. So, yeah, but goodwill is an intangible asset, but it's prohibited. Brand name is an intangible asset, but it's prohibited. But staff training is not an intangible asset. So it is not an.
I get it.
So which other one? We need 2 more. Let's see if we can pick
patent,
anyone. Yeah. What do you say?
patent.
No, patent is not prohibited though. It's not even it's not internally generated, something that we usually buy. We pay for it. Is there anyone we can pick from here to add to our points? I've already seen like 2 that we can pick from here.
Trade secret.
Yes, that's correct. Trade secrets is internally generated.
Trademark.
No, trademark is not internally generated. It's something that you pay for. There is a ministry that if you want to trademark your product, you would pay and they will give you the trademark. So that no one else will use it. Trade secret, right?
Franchise.
You pay for franchise now. You want to use NNPC's name. You pay, it's not free. That's franchise. How about customers contract? That one can also
Also,
fly. Customer contract can fly. Okay, so those are internally generated, and we have those lists here. Okay, now let's solve a more advanced question. This was an extract of a question in May 2022. And if I'm reading questions in the exam, I've told you before, start with the requirement of that question. So in this diet, the examiner wanted us to prepare with comparative figures, statement of financial position extract of AZ Nigeria Limited as at June 2020, show relevant notes for PP and intangible assets for 9 marks. Okay, 9 marks, if you multiply this 9 by 1.8, that means that's the number of minutes you will spend on this question. So don't forget, they say prepare with comparative figures. So that means they want us to also prepare that of 2019. So we'll have two statements, June 30th, 2020 and June 30th, 2019. So let's look at the question. So this question, they gave us a non-current asset register of AZ Nigeria Limited as at July 1st. So July 1st is like the beginning of that year. They gave us field office equipment and computer software. They gave us costs. These are the costs of valuations. Then they gave us accumulated depreciation or amortization. And they gave us all these figures here. Of course, by the time you remove the accumulated depreciation or amortization from the cost, you get the carrying amount. Okay, so they then gave us some additional information. Number one, they said the computer software license was acquired from Microsoft Zap Incorporated on 1st of July 2018 and has 10 years lifespan. And I said, in June 2020, a review of the sales of the computer software showed a very big decline in patronage. As a result of the review, estimated recoverable amount of the license as at June was 333 million. The license is amortized on a straight line basis. Okay, you see, for the fact that I've read the requirement of this question, things are a bit easier for me to understand. Number one is that I know that the year end of this company is when they want me to prepare this account, which is June 30th, 2020. So immediately, when I got here and I saw that they gave me this schedule in June 2019, immediately I know that, okay, so these are figures at the beginning of the year. So when I got here too, I know that since they told me that this asset was acquired in July 1st of July 2018, I know that if I'm preparing my account in June 2020, immediately I know that, okay, that means they acquired these assets 2 years ago. 2 years ago, 1920, 2 years ago. So, and I can see that in June 2020, which is the end, this guy, they did a revaluation. I mean, from all of this, they did the revaluation, they revalued the software and is now 333 million. So They revalue the asset at the end of the year. At the end of the year. So, and of course, I already taught you this. Whenever there is a revaluation, I've told you that the first thing you need to identify is to know whether you're making a revaluation surplus or a revaluation deficit. That's the first thing we'll do here. We'll see how that works very soon. So the second additional information speaks to the freehold property. It said it consists of land and building, which were revalued a few years ago for 395 million the land, 600 million to the building. So if you add these two together, that would be 995, yeah, which is this 995 here for the freehold property. So that was the last time they revalued it. Of course, that would be the new cost of the asset. Okay, they now said on that date, the useful life was 24 years. And I said, however, a second revaluation on July 1st, 2019. Again, I know that this is the beginning of the year. They revalued the land at 410. How did I know that is the land? They said attributed to the land. They revalued the building at 560. How did I know that is to the building? They said to building. They now say that the useful life is 20 years. That is on June 2019. Quite straightforward. So I know that whenever there is a revaluation, what I've taught you, which I will still apply here, is that the first thing you need to do is to determine whether we are having a revaluation gain or a revaluation deficit, a revaluation gain or revaluation loss. Finally, it says on January 1st, 2020, an item of office equipment was purchased for 128 million. So when I see on January 1st, 2020, I know that this is during the year. This is during the year. And whenever they acquire an asset during the year, the first thing that will come to my mind is that, okay, that means my depreciation on that asset for that year will be prorated, unless the examiner tells me otherwise. But let's read further. They said, and a further 22 million was spent on commission and installation of the equipment. They said annual depreciation is charged at the rate of 18.5% on costs and is appropriately apportioned on time basis as situations demand. There were no disposals of non-current assets during the year to June 30th, 2020. Required. Prepare with comparative figures, statement of financial position extract of AZ Nigeria Limited at June 30th, 2020. Show relevant notes. Okay. So let's pick them one by one and we'll show our workings. For the computer software, which is the first one, I told you that when they told us here that they revalued the assets, that's the major thing there. So the first thing I did was to calculate my evaluation deficit or surplus at the date of evaluation. I was given the fair value of these assets to be 333 million. Look at it here. Highlighted 333. I compare that with the carrying amount, which is always the cost minus accumulated depreciation. The cost of this computer software in the schedule was given as 1.1 million. 1.1 million. And the accumulated depreciation is the brought forward from last year is 110 million from the schedule. This is this depreciation or accumulated depreciation till the beginning of this year, right? So that's why I call that brought forward. Then the charge for the year, meaning the amortization for the year, is just cost all upon the useful life to give me this current year amortization. And I already know that this is the costs. And the question told me the useful life. It told me that this asset has a 10 years lifespan, right? And they told me that it's amortized on a straight line basis. So the depreciation for the year is just this divided by 10 years. Of course, I would expect the same amount every year, which is why this is the same thing as that of last year. But for me, I care less. I just get my carrying amount, which is 1 million minus 220. That gives me 880. By the time I compare this with this 333, I'll find out that my revaluation deficit is 547. 547. So again, as at the year end, this is the new value of the assets. As at the end, this is the new value of these assets. And that's what we show in the statement of financial position. It's just 333 million. The second one, which is the freehold property, again, there was revaluation here. This one was revalued at the beginning of the year, both land and building. So again, for the freehold, the first thing I will do again is my revaluation deficit or surplus at the date of revaluation. At the date of revaluation. So I will compare the fair value, which I get as 970. And come and see the way I got the 970. Is 410 for land plus 560 for building. That's what gave me that 970. I will compare that with the carrying amount of the freehold premises. And the carrying amount of this freehold premises at this date, you don't have to stress yourself. This is the carrying amount. This is it here. They've already done it for us here. This is the costs, 995. This is the accumulated depreciation, 100. This is the carrying amount, 895. Since we are doing it at the date they gave us this, I'll just use this directly. So by the time I compare the two, I will get a surplus because my fair value is higher now. I will get a surplus. Now, since this is at the beginning of the year and I need my figures at the end, so the second thing I will need to do is to then get what is my depreciation for that year. Since this freehold premises comprises land and building, land is not depreciable. I will only depreciate the land. Sorry, I only depreciate the building. So it will just be the fair value of the building at the beginning, all upon the remaining useful life. And if I check back the question, the fair value of the building at the beginning given was 560 million. And it told me that the remaining useful life is 20 years. So I simply do 560 divided by 20, which gives me 28,000. So I have my depreciation. So my carrying amount at the end of the year is the fair value of the land and building, which is 970, the same thing I used there, minus the subsequent accumulated depreciation in this case, which is 28. And that gives me 942. I mean, my students that are not sleeping and are following and are revising, they should be seeing something to take home here. Something to take home in the sense that when this asset was revalued at the beginning of the year, we had to compute depreciation at the end, and we remove that depreciation from the fair value. But in this first one, when fair value was determined at the end of the year, that means the accumulated depreciation till the end of the year will have been cancelled out. So the carrying amount at the end of the year will still be that fair value. will still be that fair value. All these we did in our last class. Then the final one here is this third one, this office equipment. And the only thing happening here is that they bought it during the year. That means depreciation is going to happen during the year. So where is the office equipment? Okay, it started from 525. So let's see. So for the office equipment, to get my carrying amount, I would prepare my costs. Then at the beginning, the cost of the asset was 525, as shown to you in the schedule here. 525, this one. Then during the year, there was some additions, which is this 128. And of course, this commission and installation would be capitalized as well. So 22 million will also be, so 128 plus 22. These were additions. It gives 150. That means the balance at the end is 675. Then my depreciation. At the beginning, my depreciation was 334. This is this from the schedule at the beginning, this 334. Right? So the depreciation method here is reducing balance basis. They tell us, they didn't tell us. They didn't tell us whether it's reducing balance basis or straight line basis. So is there anybody that can try? This question did not tell us whether we should use reducing balance or straight line. Which one are we going to use?
Straight line.
Straight line. Okay. If that is a guess, then you are wrong, because they actually told us. They said 18.5% on costs. So if they say on costs, that means mostly the cost will not change. So except if there is an addition, that means you will still get the same amount of depreciation every year. So that's straight line. So whenever they say on cost, a percentage on cost, I mean, it's the same amount of depreciation you will get every year. So it's straight line that we are using. So our charge for the year. So I did 18.5% of this one, 525. Then 18.5% times 150 times 6 over 12. The reason for that is that these 128 and 22, they were brought in during the year. So I cannot charge full year depreciation. You see, ordinarily, it should have been 18.5% on these costs. This one, this cost at the end. But because a portion of this cost was brought in during the year, so I have to prorate that. And it was bought in January. So from January to June is 6 months, which informed prorating it by 6 over 12, right? So if you punch your calculator on all of this, 18.5% of 525, whatever you get, add it to 18.5% of 150 times 6 over 12, it gives you this. So by the time you add this, you get your depreciation at the end of the year. Where we are going is the carrying amount, which is the cost, 675, minus the accumulated depreciation gives me carrying amount. And that is all for this correction. So all I just need to do is now to prepare my statements. So these 9 marks, right? The examiner just asks you to prepare statement of financial position, and they give you a fixed asset schedule. Of course, what they want you to calculate is just carrying amounts of those assets at the end, at these dates, which is what we have actually achieved in all these workings. So my statements, June 2020, and they want, of course, comparatives. So the freehold premises, like you have gotten up there, is 942. This is 942. That's the carrying amount. The corresponding, I will get that from the schedule. the corresponding, I will just get this, it's just this one, this value at the end, this carrying amount is the opening carrying amount that we just use. So I'm going back there. Then the office equipment, this 230, this is the 230 that I got. And of course, the corresponding was gotten from my schedule. Then under intangible, I have my computer software. I put that as 333. Of course, the corresponding was gotten from the fixed asset schedule. So that's for 9 marks that diet. Okay, so that's this question. Now, there are other 2 questions here that if I wish, because I still have time, I could continue to solve this for you. But I have this question of November 2021. This is not the full question. I've just removed some. I would really want you to attempt this question. I know the solution is here, but just attempt it and see if it's something you can understand. And there's another one here that I put as practice question, end time. This is even the one I'm more concerned about because I'm still going to teach you this later. I'm just going to solve something similar. But this one is similar to the one we just finished solving. It really focuses on how to determine carrying amount and all of these amounts, depreciation and the rest. So try your hands on this one before you even go to the solution. Prepare the statement of profit or loss, prepare statement of changes in equity, prepare statement of financial position. Let's see where that will actually get us. Okay, so whatever you come up with, let's look at it together next week. So for me, I'm going to stop here for today. So you have a lot of assignments to do. These are topic for next week. Next week, I'll be teaching you leases next week. So this week, I'm supposed to give you a mock exam, but of course, you guys are not seated directly in a class. So what will happen is I'm going to send the mock exam to you tonight. I will send it to you tonight. So it's expected that you submit it to me within 24 hours or anytime I send it to you. So I don't know whether some people are on my group here that are also in my physical class, and I've not done the mock exam for my physical class student. I don't want my question to leak. Somebody should not go and send it to the physical class students, and I've told them they will be having mock exam this coming weekend. So I might not send it tonight, so probably I'll send it over the weekend. Then I will send it on Saturday. You'll be expected to submit it on or before the end of Sunday. So you have a lot of work to do, and I'm intentionally closing early because I'm 100% sure a lot of you are tired and all of that. So I'm done for tonight. So let's keep the reading up. So next week we are going to be looking at IFRS 16. Do you have any questions? Okay, so I'll see you guys next week. Bye.
All right, so thank you,
Thank you,
sir.
sir. Good night, sir.
Good night.